So for those on the phone, this is Joe Sapp. I'm the Chief Operating Officer for Talley Management Group. I've also got Tim Bauer, who's our Director of Association Solutions Consulting, which is a division of TMG, and Ed Gorman, who is our Director of Client Accounting as well. So I'll be leading this. Those two will probably be jumping in here and there. Since we do have a smaller group, I've gone ahead and let any of the attendees jump in with questions as you want. If you want to mute, if you don't have a question, please do. But you're certainly able to jump in and ask questions as we go. So our session today, this is actually our first webinar of a new client education series. So we're really excited to do this and to have you as part of it. So feel free to jump in, ask questions. The recording of this will be made available afterwards as well in a new resource center that we're going to be launching soon. So our agenda up on the screen there, we're going to go through the responsibilities of a board. We'll look at financial statements, the balance sheet, statement of activities. We'll talk about how those two interact, cash versus accrual accounting, banking and investments, and then 990 tax filings as well. So first few slides here talk about the duties of an association board. And I won't read through all of these, but these are some very common duties that you should be aware of as a board member. Duty of fiduciary duty of the board. You know, the short of this, it means you're required to act reasonably, prudently, in the best interest of the organization, to avoid negligence, fraud, avoid conflicts of interest. You know, that's one of the basics of your role as a board member in terms of your fiduciary duty. Duty of care, you know, this is a broad one. It requires officers and directors to exercise ordinary and reasonable care in the performance of their duties, exhibiting honesty and good faith, you know, when they're acting on behalf of the organization. Again, you know, I won't read through the whole thing, but this is another duty that you should be aware of as a board member. And the duty of loyalty, this is another long one. You know, this is really around conflicts of interest. Your faithfulness to the association as you're leading the association. You know, there's a lot that goes into this, but you know, those three duties are main pillars of what you should know as a board member in terms of whatever decisions you're making as it relates to personal interests outside the organization, whether that's professional or business or personal. Duty of obedience. So this is another one, requires officers and directors to act in accordance with the organization's articles of incorporation, bylaws, other governing documents. You know, this is one that, you know, if you ask a board, the average board member, if they've read the bylaws front and back or all the policies, you know, it's important to do that. They should be governing documents. They should be documents that you refer to and operate based on. So it's important to understand those as it relates to your duty as a board member.
And Joe, this is Tim. If I could just add, I think another key governance document that people forget about often is their policy and procedure manual.
Sure.
Because that's typically board approved, but sometimes it's forgotten to review back on that in obedience, and also the financial policies as they may be spelled out within that document.
Right. Yeah, great point. So another point here as a board member is your reliance on experts, and the fact that you're here today means that you have a connection to TMG. So that highlights where you may have reliance on an expert to either run the organization. You know, as long as you're acting in good faith in terms of seeking legal counsel, public accountants, other professionals whose input you're going to have to run the organization, that's the key part here, is the good faith side of this, and that you can rely on experts, but it must be done in good faith. Reduce personal liability. So this is another big one that I'm not sure that I hear too much from boards in terms of understanding their own personal liability as it becomes with your further involvement with the organization. You know, if corporate leadership has personal liability, just the same as a nonprofit corporation. As a board member, you do have some personal liability there. So there's some points here that we'll go through to help minimize what that liability is. And, you know, a lot of it's common sense, being thorough, completely prepared when you're making decisions, being actively involved in deliberations during board meetings, commenting as appropriate, making inquiries, asking questions where you need to, making decisions deliberately and without undue haste or pressure, insisting that meeting minutes are accurately reflect the vote counts. You know, that's a big one because meeting minutes for a board meeting are discoverable. If the organization is in some type of legal encounter, those minutes can be discovered. So I think that's another area where you may not have, you want to be detailed, but you also want to be cognizant that those minutes could be discovered in any type of legal instance. Requesting legal consultation to be sought if there's anything unclear in terms of what's going on with the organization. You know, a lot of organizations don't have an attorney on retainer. I think it's certainly wise to do so, even if it's not used regularly. And that also depends on the type of organization. If you're a trade organization where the members are corporations and you may have a little bit more exposure or risk around antitrust, it's important to have legal counsel. Some organizations have legal counsel in the room whenever they have an in-person board meeting, just to make sure that they have that kind of support when they need it. Requesting the association's accountants assess and evaluate any matter that has significant financial ramifications. Obtaining and carefully reviewing both audited and unaudited periodic financial reports. So, you know, that's a big one. You know, TMG provides financial reports typically monthly to each client. Those are unaudited. You know, each year we recommend to our clients to seek an audit from a third-party accountant, so you can either have an audit or review. And we'll go into a little bit more detail about which each of those mean, what those activities are. Attending the meetings, reading the publications, the organization, the policies, and again, reading the bylaws, the articles of incorporations, other governing documents. So it's important to be involved. If you're going to be part of the board, part of that leadership making decisions, you have liability and you need to be involved. You need to understand the decisions that are being made because you are making those decisions and you represent the organization. Again, there's also that last line there about liability of officers and directors being limited through indemnification by the association. You know, there are insurances that you purchase, whether that's directors and officers that protect you, different liability insurances for the organization, insurance for event cancellation, terrorism-related events. You know, it's important to understand what those are and that you're asking your management about those, whether you should have them, what kind of coverages you should have, and make sure you review them. Don't make that another renewal that happens every year. Take time to understand your coverage levels, where you may have gaps, and work with the right partners to do that. So apparent authority, this is another one around liability of an organization and anyone that's involved in association management. This is the hydro level case is referenced in about every prep course for the CIE certification exam. This is the legal case that established that association could be held liable for the actions of its officers and directors, essentially saying that there is apparent authority. So whether you're involved as a board member and you're out there making decisions or saying certain things as a board member, you have apparent authority. You may not have the decision-making power within the board to sign a contract or to engage something, but the fact that you're on the board creates that apparent authority, and the association should be held liable for those actions. So this is one that doesn't come up too often, but it is important because it does have an impact on your liability as a board member.
Yeah, and Joe, this is Tim. If I can add, it should tie back to your communication plan. I often call it the who, what, and when. Who can speak on what topic and when can they speak? And if you want to add another what, it could be what is the approval process for that statement or speaking or point of clarification from the association.
Yeah, that's a great point. Okay, antitrust. So this is another one or a liability that you see more antitrust discussions and issues around trade associations where the company is the member. The Sherman Act, which is the principal antitrust statute, and when you hear Sherman Act, you typically think corporate activity, and the biggest impact here is that if you're engaged as a trade organization and you have certain discussions in a board meeting around product, services, pricing, that's all going to fall under antitrust. Associations can be a common target for it, just because of the nature that you're bringing together different companies around the table. So that's probably the biggest benefit of having legal counsel involved in your board meetings, is to be able to ensure that there's some gaps there in terms of your antitrust coverage. Yeah. Again, price fixing is the number one target there. Tim, did you have something you want to jump in on?
Yeah, well, I just go back to our CAE ethics training, where they said if you think the board or group, even at a social event or table, is steering towards anything price fixing, regional gouging, walking out certain competitors, anything like that. I don't know if you remember, but you're supposed to drop your portfolio on the table and say, we're crossing a line, I'm leaving the meeting, to draw attention to the fact that one, you're leaving the meeting, but two, you're uncomfortable with the conversation, so that people can start being aware that they're crossing the line. And I still go back to that training however many years ago. I've never had to use it, but it's just a good point to make sure that people know you're uncomfortable. Again, back to the duty of care, duty of obedience, to protect the association and to protect yourself legally as a board member. Make it known that you don't want to be part of the conversation.
Yeah, and price fixing is the one that is mentioned here, but another example of this would be restricting access to the association based on size or some other factors. If it's a trade organization where you may restrict somebody from getting a certification or an accreditation that's going to harm their business because they're a competitor. So the balance sheet, this is jumping into the financial statements, common financial statements. This is one of the most common. It's a report that lists the organization's assets and liabilities at a specific point in time. This is a snapshot, and when you look at the example on the next page, you're going to see the common accounting question, which is assets equals liabilities plus shareholders' equity. Associations, of course, don't have shareholder equity, but that's the common financial question there. So why the association has to pay for all of the things it owns by either borrowing money, which is taken on liabilities, or taking it from investors issuing shareholder equity. So what's in the balance sheet? Again, there you see assets could be cash, inventory, property, liabilities, rent, wages, utilities, taxes, loans. And then again, shareholder equity, that's not part of associations, but whenever you do look up the balance sheet, you're going to typically see that for any corporate entity. So assets, again, diving in a little bit deeper, listed in the order top to bottom in order of their liquidity, which is ease in which they could be converted to cash. Current assets, cash equivalents, that's the most liquid. Marketable securities, so equity or debt securities. Accounts receivable, money that customers owe you. So that's typically sponsorship. Typically, we don't view dues revenue as an accounts receivable unless it's specifically been requested to be invoiced. Just because you have X amount of members that are due to renew, they could always make that decision not to. So we typically don't view that as accounts receivable. Inventory, any unsold goods that have already been purchased, and then prepaid expenses. So that could be insurance for the year, rent if you paid rent in advance. You know, an example that you see a lot with prepaid expenses, especially if you're in accrual accounting, is making payments towards a future event where you haven't recognized that expense yet, but you've already paid it, such as a deposit for an event venue. Long-term assets, long-term investments cannot be liquid within the next year. Fixed assets, land, machinery, buildings, and then intangible assets, which are non-physical, so intellectual property, goodwill. Again, if there's any questions as we go, please feel free to jump in. So looking at liabilities, the money an organization owes to outside parties, interest on bonds, salaries, current are due within 1 year, long-term are due any point after 1 year. So under current liabilities, you're typically going to see your current portion of long-term debt, bank indebtedness, interest payable, rent, taxes, utilities, wages, prepayments, dividends payable, earned and unearned premiums. Long-term debt, pension fund liability, deferred tax liability. Typically an association may not have as much long-term debt, which is typically going to be for a smaller association around potentially a pension fund if they've hired their own staff in the past, or long-term debt from loans or other types of programs.
Hey, Joe, this is Tim. If I could add to that, I know you're going to talk about the difference between cash and accrual-based accounting later on, but also from a liability standpoint, depending on how your membership year cycles or how you earn that membership, you might see that as a liability. Any membership revenue or convention revenue that isn't earned because either the event didn't happen or the membership wasn't serviced in full capacity, you also may see that as a liability, which I know sometimes volunteer leaders go, whoa, do we really owe all this? And you don't. That's revenue you receive that as you deliver the product, service, or membership, that will leave your balance sheet liability and it will earn into a revenue category.
Right. Thanks, Tim. So shareholder equity, again, this is on there because if you look up resources on balance sheets, you're typically going to see this. There isn't anything really to talk about in terms of associations. An example here, so this is an example balance sheet. Our terminology internally, statement of financial position, those are interchangeable in terms of describing this report. So when you look at this report, you see the two columns there, year to date, which is 12/31/2016, and then prior year to date, 12/31/2015. So it's comparing those two periods of time, and you can look through where you see the cash in 12/31/16, they had $215,000 in cash. At the end of 2015, they had $123,000 in cash. So their cash increased between those two periods, which is a good thing. And then you can look through and you can see the different types of current assets that are listed there. So one thing to note here is their accounts receivable went down. That could be viewed as a good thing. Short-term investments, that went down. Other current assets, that went down. So at some point they dropped some assets and that might have been converted to cash. And then prepaid expenses. So that rose from $4,000 up to $17,000. And inventory stayed consistent as well. So then you look down at the liabilities. Again, those are common liabilities, accounts payable, accrued liabilities, deferred revenue, sales tax, line of credit. Those are all listed as current liability. So the thing to note here, when you do a quick glance at this, total assets is going to always equal total liabilities and net assets. If those numbers are off, then you've got a problem there. So that's a key thing to look at when you're looking at your balance sheet. Ed, Tim, anything you want to add there?
Not at all. I think you covered it wonderfully and completely. Great.
So statement of activity. So this is the second common financial statement, income statement, as it's called sometimes as well. So this is also called the profit and loss statement. This is what you're typically looking at throughout the year to assess your current performance on the given year around revenues and expenses. You'll see the key areas: revenues, expenses, gains, losses. Net income equals total revenue plus gains less total expense plus losses. Revenues and gains: operating revenue earned from primary operations for an association. That's typically your dues, revenue, event registrations. Non-operating revenue earned through secondary and non-core business activities such as interest earned, royalty from strategic partnerships, rental from properties. That's not common, but something that you may see from association. Gains, sales of long-term assets, income from a one-time business, non-business activity. So commonly what you may see with an association is that they've built a program that's very successful, and at some point in time they may sell that either to a for-profit company or another nonprofit entity. That's very common. It could be also that the nonprofit has a for-profit subsidiary corporation that they earn revenue from as well. So when we talk about non-operating revenue, something that we'll touch on is unrelated business income and how that could impact the association's financials in terms of that being taxable. So expenses and losses, primary activity expenses incurred from normal operations. So cost of goods, administration, depreciation, amortization, wages, sales commissions, utilities, that all is under primary activity. Secondary activity would be interest paid on loan money. So here's another example of income statement or profit and loss statement, depending on your preferred terminology. You'll see your revenues and gains at the top. So sales revenues, interest revenues, gains on sales and assets gives us a total of $108,000. And then at the bottom there, you'll see expenses and losses. So your cost of goods, commissions, office supplies, which totaled $90,000 with a net income of $18,000. So pretty basic financial statement. Again, this is showing the performance of this organization for the first 5 months of their fiscal year, which ended on May 31st of 18. So before we go any further, any questions around those two statements, balance sheet and statement of activities?
I'm good for now, Joe.
Great. Okay. Jumping into the next, cash versus accrual. Tim and I both have referenced this already. Cash method is revenue reported on income statement only when cash is received, and expenses are only recorded when cash is paid out. This is most commonly used with small businesses and individuals. It's not something that you won't see with an association. Some certainly use that method. T&G, all of our clients use the accrual method, which is preferred for an association, which is revenue is recorded when earned, and expenses and goods and services are recorded despite no cash being paid out for those expenses. So an example here that we give, registration for the 2021 annual meeting is received in July of 2020. It's reported on the balance sheet via being an asset and a liability, but will not be reported on the income statement until the event occurs in 2021. That's an example of deferred revenue. It could be the same for an expense as well. If you paid a deposit on the convention center, that's going to be listed on your balance sheet as a prepaid expense, but it's not going to show on your statement, your financial statements just yet, your statement of activities just yet. Records accounts receivables and records accounts receivables and payables on the income statement. So any questions on the difference between those two? I think it's fairly common for, at least for TMG clients, that accrual is the preferred method and what we use with all of our clients.
I don't have a question on the cash or accrual, but is there like a default or it's a real well-known software package for those financial statements for small businesses?
Yeah, so Ed, I'll let you jump in if you want, but you know, there are plenty of good platforms out there. TMG uses exclusively the Intact platform, which is a cloud-based accounting platform. QuickBooks Online is another one that's common that can be used with pretty easy setup. And
that's the one I've heard of, so I thought there might be some gravity around that one.
Yeah. To Joe's point, QuickBooks Online is the most recognizable small business platform. A smaller or lesser known one would be Peachtree, but those are the two main softwares used by the smaller businesses.
Very good, thank you.
All right, banking and investments. So we're not going to get into how the markets are performing today because that may give us all a little bit of heartburn. But associations maintain operational bank accounts just like you may for your own business or your personal, checking accounts where most of the revenues and expenses occur. So that can come in many forms. It could come in just a regular checking account with a savings account earning a small amount of interest. Money market accounts are also prevalent. And there's also some other investment tools that could be used as well. When you think about long-term reserves, most associations are talking about their investment accounts. And those are really focused on the long-term, building a long-term reserve strategy so that the organization can weather a rainy day down the road. Really, it's about seeking a balance between cash flow needs and reserve fund. Right now, I think if any organization has an investment account, you're probably looking at it when you probably shouldn't be, and understanding that it's there for the long term. While the markets may be down today, as long as you're not needing access or worried about that, getting access to that capital today, to just let it play, let it sit, and ensure that it's there for a true rainy day, not just to pull it out because of the market fluctuations. Anything to add there, Tim or Ed?
I think you captured it nicely. And the big point is right now, obviously, the volatility of the market, not to pay attention to it right now.
Yeah. And, there are several different opportunities around investment tools and products. Your typical one is to work with an investment advisor, set up a policy around what's your target, what's your comfort with risk, and to develop a sound investment policy that you have a trusted fiduciary investment advisor to handle. You've also got some other traditional investment tools like CDs, certificates of deposit, that an association could use as well. That's less liquid. Right now, if you have an investment account, typically it's fairly liquid. You can get access to that cash within a day or two. With a CD, you may not have, you don't have the ability to pull that money when you need it. And then there's some other tools that are coming online that we've begun to use with clients. One in particular is called Flourish Cash, which earns about a 1% yield right now, which is, it's not a true checking account. It's not a true investment account. It's something that an association could put in place in between the two, where you can set up some automation rules to ensure that your cash flow needs are met with your main operating bank account, but earning a little bit of interest on any extra cash you may have that you don't want to put into an investment account, because you might need quicker access or not want to risk the volatility that we're seeing right now. Reviews and audits. So I'm sure everybody's familiar or heard these two terms. Our recommendation as an AMC is to seek an audit at least every 3 years. Definitely every year you want to at least perform an audit or a review. An audit is the strongest process, which is going to test the processes and the procedures to ensure that financials are presented accurately. So what that means is that the auditor is going to go through and look at transactions. They're going to look at your policies and make sure that you're following through with those policies. So that's where it's really essential that, regardless of your management structure, that you have in place the policies, you have this segmentation of duties within your accounting to ensure that you're holding up to those audits. Again, they're best practices every 3 years. Audits and reviews should never be done by the same firm who does your association's monthly accounting. TMG handles the accounting for our 26, 27 full service client partners. We don't do audits. We don't do reviews. We work with the third party audit firm to ensure those are done. But we're not the ones performing that work because those audits and reviews are looking at our work with your financials. 990 tax filing. So each year an organization has to file a Form 990. Any organization that's less than 25,000 in receipts can file an EZ form, which is a very short, easy, as in the name, form to submit. Typically, the third-party firm, the auditor, accounting firm that's doing your auditor review is going to complete that work with their auditor review. Pretty simple. If you have ever navigated to the guidestar.org website, you can actually pull 990 filings for any association, for most associations, and it's pretty interesting to take a look through. Whether it's your own, as a board member, you're going to get a copy of your 990 filing and you can have access to that. But there's some opportunity to look at those filings, whether it's a competitor organization or a related organization, just to get an understanding of how they earn their money, what they spend their money on, and get an understanding of the organization. For most organizations, an activity that comes up is unrelated business income. So that is when an organization may have to pay tax on any revenue that is not part of their core mission. So what does that mean? Trade or business, it's regularly carried on and not substantially related to furthering the exempt purpose of the organization. That is now more than ever, that continues to come up around government regulation and how they view unrelated business income. So a lot of organizations don't experience it, at least the ones that we interact with, but it is something to be cognizant of as you talk about what kind of programs and how you earn revenue as an organization, whether it's related to the core mission of the association or not.
Hey, Joe, this is Ed, if I can jump in. And I don't know if this was my mistake in my materials I provided to you, but the less than 25,000, I think, should be less than 250,000 for the EZ form.
Oh.
And the postcard would be 50,000.
Right. Yeah, that might be bad.
And that might have been my mistake on the forms.
Yeah. So regardless, most organizations that we work with at TMG are filing a full 990 anyway. The EZ is mostly for very small organizations. So, that covers most of what we wanted to talk about. It's a quick overview about association financials, what to look for, what you see in your monthly financials, and so a little bit about your duty as a board member and what you need to be cognizant of around liability as well. So happy to answer questions. Again, we're going to make this recording available. We'll make the slides available. We're also going to have other resources that we're going to be posting in a new client-only resource center on the TMG website. So you have access to a lot of different things, policies, sample documents, and whatnot. So happy to answer any questions that might be out there.
I think you answered all my questions, Joe. I did have maybe one thing I wanted to ask you about, but I can wait till after the recording is finished.
Okay, great.
This is Rosemary from NCME. I'm actually connected on a telephone, even though I can see the screen. You mentioned financial advisors, and actually we're in the process of looking for a financial advisor. So we were wondering, and maybe you could do this offline, if you folks had any financial advisors for an organization like ours that you would recommend that we could check in with once a year. We're using Vanguard for our investments in general at this point.
Sure. So, you know, most of the time, the investment advisors that we work with are managing the funds for our clients. I know I've spoken to Ethan a bit about that as it relates to your organization. I'd be happy to follow up offline and share who are some other groups that we work with in terms of investment managers and other services that may be out there.
Yeah, thanks. Right, because we just got out of that kind of an arrangement. The board wanted to end the fee-for-service financial advisor arrangement. Mm-hmm. Or no, we want to do a fee-for-service financial advisor. We got out of the ones where, you know, they get a commission and their funds, they're with the group. I didn't explain that well, but I think you know what I'm talking about.
Sure. Yeah. No, having a fiduciary that, you know, they're responsible and they have to make those decisions for you and on the best possible investment advice for the organization is important.
Yeah. Okay. All right. So Ethan can get back to us on that too, or I'll just reach out to him via email. We're having a committee meeting today, so I'll take it from there.
Sure. Sure.
And thank you for doing this. This is helpful.
Sure.
And I actually think the slides would be good if they're available to board members, you know, if we can share with our budget and finance committee too, and I think the board will find it useful.
Of course. Yep. We'll share them with everybody.
Yeah, I was going to say the same thing. If you don't mind forwarding the slides out, I could use them for my records too, if you don't mind.
Sure. Be happy to. Any other questions out there? All right. Well, thank you, everyone. I appreciate you jumping on and joining us and asking questions. This is a great first webinar for us. Hope you come back for a future one as we get those scheduled and out there. So thank you again.